Iran just launched a drone attack on Bahrain. Another ship was hit in the Strait of Hormuz. Hezbollah supporters are blocking roads in Beirut, surrounding government buildings, screaming that Lebanon sold them out in a deal with Israel. By any measure, this looks like a regional escalation. So explain this. Tanker rates for shipping through Hormuz have nearly halved in recent weeks. War risk insurance premiums, which spiked when tensions first flared, are now plunging. The oil market is acting like the crisis is over. Something doesn't add up. Either the headlines are overblowing the danger, or the markets are underpricing a serious threat. Let's dig into the data and figure out what's actually happening. First, the attacks. According to reports, Iran conducted a drone strike against Bahrain, a key U.S. ally in the Gulf. This isn't some isolated incident. It's part of a pattern. We've also seen yet another attack on a foreign vessel on the Strait of Hormuz, the choke point through which roughly 20% of the world's oil passes. These are not accidents. These are calculated moves. Meanwhile, in Beirut, Hezbollah supporters, Iran's most important regional proxy, are out in force. They're blocking roads, surrounding government buildings, protesting what they see as a betrayal in Lebanon's recent agreement with Israel. The message from the street is clear. Iran's axis of resistance is angry, and they're not backing down quietly. If you just read the headlines, you'd think we're on the edge of a major regional conflict, and maybe we are. But here's where it gets really interesting. MarketWatch just published a piece noting that Iran's recent ship attack is testing the shipping insurance market at the exact moment when war risk premiums had plunged. Think about that. Insurance underwriters, the people whose entire business model depends on accurately pricing risk, had just decided the Hormuz situation was calming down. Premiums dropped. Then Iran hits another ship. Uh-oh. Now, insurance markets can be wrong, but they're usually not wrong for long, because being wrong costs them billions of dollars. So, they're about to reprice risk sharply upward, or they're seeing something in the operational data that suggests these attacks aren't as disruptive as they appear. Which brings us to the tanker rate story. According to the latest data, tanker rates for routes through Hormuz are nearly halved compared to their recent peaks. We're talking about the actual cost to charter a vessel and move oil through the strait. That's not a futures contract. That's not speculation. That's the price of hiring a ship, negotiated between real buyers and sellers who have to physically move barrels of oil. When rates halve, that tells you supply and demand are balancing. It tells you ships are moving. It tells you the market believes the route is open for business. And here's the kicker. The volume of oil moving through Hormuz is reportedly approaching levels we saw before the Iran conflict escalated. So let's connect the dots. Iran is absolutely escalating on the military and political front. Drone strikes on Bahrain, ship attacks, proxy unrest in Lebanon, that's all real. But the shipping market is saying the actual disruption to oil flows is minimal or temporary. Tankers are getting through. Volumes are up. Rates are down. This is the kind of contradiction that mainstream coverage glosses over. You'll see breathless headlines about Iran attacks, or you'll see energy analysts saying the oil market is normalizing, but rarely do you see anyone put them side by side and ask the hard question. What does this actually mean? Here's one interpretation. Iran is signaling. They're reminding everyone that they can disrupt the strait. They can hit Gulf targets. They can activate proxies. But they're not actually shutting down the oil flow, because that would cross a red line that brings in a much heavier international response, possibly direct U.S. military action. So they're calibrating. Enough violence to stay relevant, not enough to trigger a full confrontation. If that's the play, it's working, at least for now. The attacks keep Iran in the headlines, keep pressure on regional rivals, but don't spike oil prices enough to force a market panic or justify a major Western military response. Meanwhile, shipping companies, insurers, and oil traders are reading the situation as manageable risk. They're pricing in sporadic attacks, not a closure of the strait. But here's the risk no one's talking about. Calibration can fail. One miscalculation, one attack that kills the wrong people or sinks the wrong ship, and suddenly you're in a totally different game. Markets can reprice overnight. We saw it in early 2020 when the U.S. killed Soleimani. Gold spiked, oil spiked, safe haven assets surged. Then it all came down. But for a moment, the risk was very, very real. Right now, if you're watching gold, it's holding elevated levels, but not breaking out. If you're watching oil, it's range bound. That tells you the market's in a wait-and-see mode. Elevated risk premium, but not panic. For investors, the question is whether that premium is adequate. If Iran keeps this up without crossing into full disruption, you're probably fine holding energy exposure, maybe some gold as a hedge. But if the calibration fails, if one of these attacks spirals, you're going to see a sharp move in crude, in shipping stocks, in defense equities, and in safe havens. One more thing worth noting. We don't have clear visibility into whether the U.S. is backstopping the maritime insurance market. During previous crises, there have been discussions about government support or guarantees to keep ships moving when private insurers get skittish. If that's happening quietly behind the scenes, it would explain why premiums dropped even as attacks continued. It would also mean the market is pricing in an implicit U.S. commitment to keep Hormuz open, which is its own kind of geopolitical signal. So, where does this leave the Iran negotiations? Hard to say. The attacks suggest Iran isn't feeling generous. The protests in Beirut suggest their allies are frustrated and possibly harder to control. But the market data suggests Iran isn't ready to blow things up completely. They're playing a dangerous game of brinksmanship, and so far, they're threading the needle. Bottom line, the headlines and the market data are telling two different stories. The headlines say escalation. The data says normalization. Both can be true for a while, until they can't. If you're trying to make sense of this for your portfolio, watch the tanker rates and the insurance premiums more than the news cycle. Those are a lot harder to fake. If rates start spiking again or if insurers pull back, that's your signal the risk is real and repricing. Until then, it's a managed crisis. Uncomfortable, volatile, but not yet out of control. We'll keep tracking this. Tomorrow we'll look at the energy markets, see how they're positioning ahead of the next OPEC decision, and whether there's any signal in the futures curve about expected supply disruptions. So check back tomorrow for a full update here at Markets Only. And remember, be good or be good at it.